A personal guarantee shouldn't be something that scares you off.
Right.
Because if you're getting into franchising and you're opening a brick and mortar business, you have to sign those anyway. You're going to be guaranteeing a lot of things personally. Listen, the other side of the coin of an opportunity is risk. That's part of the risk.
Right.
So you're betting on yourself and you're betting on your franchise partner to have a business model that works. Just keep in mind there's going to be exposure personally regardless of which way you go. And that's just part of doing business. Suzanne, Rob, what's happening?
Rick Mayo.
What's going on?
Oh, gosh, a lot's going on.
Yeah, you got that right.
We're
busy.
busy.
Like, hey, can we do a podcast? You're like, yeah, what's it about? 5 minutes later. But good news is this is your world all day, every day.
All day, every day.
This is not going to be a reach for you to come up with this info.
You actually texted me last night and said, hey, tomorrow podcast, here's the subject matter. I'm like, oh, piece of cake.
All right.
I can talk about that all day long.
Sure. That's it. I'm like, I love this team. I really do. Okay. Let's get the important stuff out of the way.
Yes.
Dad joke. You go.
So, I only know 25 letters of the alphabet. I don't know why. So I told that joke to somebody this morning. I won't say who. And he just looked at me like, what? Like,
really?
Why? Like, it's not Y, it's the letter
Y.
Letter Y. 25 letters.
In the alphabet, there's 26.
I said, should I pick another one? He's like, yeah, nobody's going to get that. I'm like, really?
I got it immediately. We have a very savvy audience. I'm just going to brag on them for a bit. Well, I was listening to a podcast yesterday, and it was about I drink those little tonics, and they have like kratom in them, and it was all about kratom, and it was all about can you get addicted to it or not? It was all this stuff. But did you know that I've been trying to kick it? I've got a wicked addiction to both chocolate or a combo, chocolate marshmallows and nuts. Did you know that? I've been trying to kick it for a while.
I did not know that.
It's been a rocky road. All right.
In fact, I would bet my life that you are not addicted to any of those things.
I'm really not. Even the other thing.
You can't look like that.
Right, yeah, exactly. Just eat nuts and chocolate.
Marshmallows.
It sounds amazing. All right. So what we are going to talk about, and this is if you're interested in getting into franchising or Alloy, how do you finance it, right? So another question I'd reached out to Carrie with, because I'm just, fodder for the podcast, like what are the 3 questions people ask, like right at the start of the process? And one of them is how much does it cost? And so as a dovetail off of that, how do you finance it?
Right. Lots of different ways.
Yeah. And so I think we talk about the ways and we kind of go back and forth, and I printed out a cool table on like the sort of the criteria, benefits or whatever of the main ones. And we can go through those at the end, but I think you had some things on your list that I didn't even think of, but I did write them down. So look, first and foremost, you could pay for your franchise and when we're talking about pay for, we're talking about the franchise fee and the cost to build out, specifically in Alloy, a brick and mortar franchise.
Right.
So that means you get your location, all the expenses that come with building out a brick and mortar. There is something called an item 7 that gives you a range of what that's going to cost, that you take those numbers and then you come up with an estimate on your own. It's always smart to use the upper end of that ish, right? Depending on your market.
You can never be overcapitalized.
Yeah, thank you. Perfect way to put it. And so that's the number that we're talking about. That's what we mean by how do you afford or how do you finance your franchise. Mm-hmm. So first and foremost is just cash. And so when I came up with that, I was just thinking and we have a lot of folks that do this. You just have the money and you just pay for it.
A lot of people do that.
Yeah, they do. But then you added something else, which was what? What's another way people could get cash?
Well, friends and family, or some sort of angel investor. Those would be the 2 main ways in our experience, or my experience, franchisees who maybe were underfunded, maybe didn't want to go the SBA route for some reason. They look to their friends and family, or an angel investor, a friend, or somebody who's going to invest and maybe have a minority ownership stake in the business.
Yeah, exactly. And so, what's the threshold where they have to be on our franchise agreement?
So if you're at 20%, higher than 20%, you have to be a signer, sign the personal guarantee, sign all the legal documents. If you're less than that, you just handle it on your entity, in your entity agreement, where you're a member of the entity. That's the best way to do it. And we've seen it happen a couple of times, thankfully not very many, where the partnership goes awry for one reason or another, the minority investor wants to go do something different, whatever, and buys out of the partnership, there's absolutely nothing that needs to be done in legal terms for our franchise agreement. So it doesn't trigger an event like a transfer or a change of ownership, right?
Associated with it, right?
A change of ownership or a transfer has significant expense around it. So if you have a minority investor, you want to keep that under 20%.
And a lot of folks, we've had adults, obviously, that are getting into the franchise, and their parents are older and have lots of money and are like, hey, I'll back you.
Right.
And it's not even really a loan repayment. If it is, it's something they work out personally. And in that case, we're just like, we just need to see that you have the money. So it's got to be in your account. So we look for proof of funds, right, in that case.
So in a case like that, the parents would have to go ahead and do the transfer. So it's in the franchisee's bank account.
Right.
Now, the parents aren't on the franchise agreement.
Right.
Even if they put up all of the money, they're not.
It doesn't matter.
Doesn't matter.
Yeah. And if they work out some kind of repayment on their own, whatever, we just need to know the cash is in there to fund the franchise. Got it. The next one, and we have a lot of people that do this, is the SBA, so Small Business Association. Right. And that is a straight loan. That one's, at least currently, a lot of people do it, but it's very difficult right now. They seem to change quite a bit. And obviously the interest rates change quite a bit, right?
So the advantages are typically, or in years past, have been that you don't have to put as much down, like as opposed to if you go to the bank and just get a commercial loan. And your interest rate is more favorable and the payback period is longer. But that is not the case anymore. You still have to put 20% down. Mm-hmm. You have to show that. And the process, I mean, we're very involved in helping our franchisees kind of navigate through the SBA loan. There's lots of things that the franchisor needs to sign off on and forms and different things. So we're involved in that. And it just seems to be either the banks that we typically work with, because there were a few big ones, have gotten so big now that it's just clunky. I think there's people that are working there that aren't as familiar with the process. So one of the things that I'm doing right now is looking for other resources where a bank who specializes or is very familiar with SBA loans, specifically for franchisees, working with them, they kind of vet us, and then they can kind of allocate a pot of money just for Alloy franchisees, and then we funnel our people there. It just is less friction.
Yeah, and we've been searching for that, and we've had those at times. And I like some of the franchise companies that are in that space, like Fran Fund and Benetrend, who will handhold you through the process, but they're going to take some of the heavy lifting off, and they're going to make it more efficient, right? And so they will charge you a fee to do so. But I know if I was in it, I would probably, for the bandwidth, hire them, just for me personally. So there are people who want to go that route, and they've typically been pretty happy with them.
Right. And I think those types of companies that kind of help the franchisee navigate their way through the SBA process, even with them, though, they deal a lot with these big banks that are
like Huntington and these guys.
Yes, Huntington is the one that I'm particularly thinking of. They've gotten so big that once it gets to the Huntington piece of things, now maybe the franchisee is a little bit shielded from that because they've got this go-between, which is great. But it's almost necessary, or if you're going to use a big bank like Huntington, that you have a go-between who's very savvy about this whole process and can say, now, hang on a minute. We don't do that, or we've never done that before. What is this? So in any case, if I would not recommend a franchisee just go straight to one of the big banks by themselves, and because you're just a little fish in a big pond.
Yeah, and we've had franchisees that had good relationships with their bank and did SBA through the local bank. But some banks are better than others. Some know more about it than others. Some know more about franchising. Right. But the SBA structure is cumbersome, and it takes a while. And I wanted to explain also, well, first of all, let me say that we have registered. So we are like an SBA approved franchise. So we've gone through the process to get that approval. So that does help. But the process alone is lumpy and long. But I wanted to explain one thing about SBA. if you look at sort of the investment threshold or net worth threshold to qualify to get an alloy, it seems heavily weighted in liquid, right? Which would be cash.
Right.
The reason is that the SBA is going to require you to put 20% down, and then they're not going to fund you until you get a contract in hand.
A general contractor
hired. A general contractor hired, contract in hand.
Right.
Well, between signing your franchise agreement, which there's an outlay of cash initially for the franchise fee, and the time when you get a general contractor, you are still deploying capital. Now, when if you signed up with Alloy and you mentioned you were going to do SBA, you would get on a call with our team and they're going to walk you through like what that ramp is going to look like and where you're going to be deploying this capital. But the reason the threshold for cash is higher than just 20% of the franchise is because you have to be able to cover that gap. Now, in layman's terms, you're going to get repaid, and I'm air quoting, when the loan comes through, but you still have to have the cash to gap it or your whole project comes to a screeching halt.
Correct.
Is that correct?
That is correct.
Okay,
that is
cool.
correct.
So SBA, good. Cumbersome, even with some help. Rates are a little bit more expensive these days, so debt's not as cheap and attractive as it was.
You're right.
A lot of people still go that route. There's nothing wrong with it. You should just understand what you're getting into, right?
Mm-hmm.
The next one is a 401k rollover, and the acronym for that is ROBS. Right?
Rollover Business for Business Startup.
Yep. Rollover for Business Startup. I love this one because, typically if you have a traditional IRA or, some type of a retirement account, it's really just stuck investing in the stock market. And there's nothing wrong with that. We all know the market's somewhat predictable, at least historically speaking. But man, if you want to take that money and do something else with it, what a great structure. And you can set up something called a ROBS, and you can move some of your 401k funds into a investment vehicle. And we'll talk about what that looks like rules wise, but you can do it without penalty, because if you just withdrew, everyone knows if you withdraw from your 401k, you're going to pay penalties or your, whatever your account is. So in this case, you get to set up a structure to roll it over without paying penalties, and you can use it to invest in something other than just the stock market.
Right.
So there are some rules around that, though. You want to talk about what those are?
You have to set up a C Corp in advance.
Can't be a subchapter S. Can't be a S.
It has to be a C
Corp.
Corp.
It has to be a C. Or LLC. Yeah.
Right.
Yeah.
And before you move any money. So there's some kind of timing where you have to create this entity. Then you have to withdraw. And I would highly advise anybody to talk to their, tax advisor or their wealth manager or whoever is kind of managing their 401k. And if you're managing it yourself, which I think a lot of people do these days, make sure you check with your tax advisor. So the steps necessary. You can't move it into your checking account and then move it into
you have to set up a C Corp. You have to move it in there, and then there's some other steps you have to take that are very specific to make this legal.
Correct.
And where you don't pay penalties.
Right.
Again, it's a little bit complicated, but it does move a little quicker typically than the SBA.
Yeah. For sure.
And you're not taking on any debt. You're actually just spending money that you already have, right? You're just putting it into a different investment vehicle instead of the market. I like it. I mean, I think if I was doing this, I would also employ like Benetrends or Fran Fund, because they also help with ROBS, so they would help you do it. But to your point, if you have significant assets and you're going to slide some over to another investment opportunity, definitely check with your wealth advisor and see how it works. But it is a great strategy.
I love it. I think it's great. It's your money. You're not borrowing. You're borrowing from your retirement account, but it's still yours. You don't have to pay it back, so to speak. It takes usually what we've seen, because we've had a lot of franchisees do this particular method of funding, and it usually takes 4 to 6 weeks to kind of get all the things in place, and then everything clears and blah, blah, blah. And then, and we're happy to work with franchisees on that. They can put down a small deposit, go ahead and sign their agreements. We just kind of hold things until they can fund, and then we rip the Band-Aid off and go full guns.
Yep. So I like ROBS. I think it's a great vehicle, and I have a friend that does something similar where they can help people move their wealth into a different investment vehicle, and then they can invest in real estate syndicates or self-storage or kind of any of these other alternative investments. It's basically a way to diversify your investment portfolio. You're not just all in the market, right?
Right.
Okay, so that's ROBS. The next one is a HELOC, which is home equity line of credit. And that's just borrowing against your home, the equity that you have in your home. And we have people that do that as well. We have people that have significant amount of equity in their home. Typically, when we see it, and correct me if I'm wrong, a HELOC is usually paired with something else, right?
Usually there's a combo of things. So, maybe you're going to fund some of it with cash and some of it with HELOC, or some of it with ROBS and some of it with HELOC. So a combination sometimes of these different methods of deploying capital is not unusual at all. If your average, if you're going to need to fund, say, if we're on the upper end, $450,000 to $500,000 for your build out.
You're in Orange County and you're going all in. Yeah.
First alloy, somewhere in that range. You might not feel comfortable getting a HELOC for that amount, even if your house is worth $2 million. And what I would do is I would remortgage my house, because the mortgage interest is less than a HELOC. Usually you're paying a point or two, sometimes 3% higher than a traditional mortgage. So a HELOC might be a way to, if you need $100,000 extra bucks or something like that, not necessarily a big lump sum.
Right. And so that's why it gets combined.
Right.
Maybe the HELOC helps you with the down payment, the franchise fee and the ramp,
right.
and then in comes SBA or ROBS on the back end.
Right.
And we have a lot of people that combine those, right?
Yeah.
And
HELOC's almost kind of like a little safety net, you know. That's, I think a lot of people have HELOCs just sitting there. Yeah. Just in case they have an opportunity or they need a little safety net.
Yep. And just as a side note, interesting, we had a franchisee that we really liked, and they had their home in a trust with some other assets. And just as a heads up, if you do have that, it can make it more difficult to get a HELOC, because it doesn't. You can't
get one.
You can't get one. It doesn't fit the conventional rules of getting a home equity line of credit because it's in a trust. So just as a heads up, if you're using that structure and you have your assets in a trust for estate protection, whatever those things are, it is probably a no-go. Right?
And their intention initially was to move their house out of the trust, so then they could get a HELOC when they discovered that they wouldn't be able to within the trust. And it was impossible. It was an irrevocable trust. They didn't have any wiggle room to change it. And it killed the deal.
It ended up killing the deal, which stinks for us, because that was how they were going to fund the down payment. So that's a HELOC, and I think everybody kind of understands that already. Right. And then lastly, and I didn't think of this one, you brought this one to my attention, which is just a conventional bank loan. So, and you said we've had franchisees that have done this. So describe that to me.
So we've had a couple of occasions, and in both instances, they were franchisees for years with another brand, multi-unit franchisees. And during the course of their 15, 20-year relationship with their other franchise, they had developed a relationship with a community bank in their community where they were doing business. And because of that relationship, it was just easier. Like, the banker had a personal relationship with this franchisee, knew that she or he were great franchisees, had a great track record, and felt like it was a safe investment. It was a safe risk. Right. So, literally with a signature, she could just go in
crazy. Relationship banking is such an odd concept these days. That's the way it used to be done, right?
Yes.
You had a handshake deal with your guy, and he knew you were solid, and you had enough assets in the bank. But these days, you're a faceless,
it doesn't
online
matter who
customer.
you are.
Doesn't matter who you are. Doesn't matter what assets you have. I'm sure at some level it does, but that's pretty cool.
It doesn't.
It's pretty cool that still happens.
I've had recent experience with this. I've done my banking, personal and business, with a bank unnamed for 35 years.
Right. Millions of dollars on account, still can't get anything done. I know that because we're in the same bank.
I'm talking to this guy saying, "Are you kidding me?
Right.
Like, does that not mean anything?" And he basically said, "No."
Yeah.
It really doesn't. It really doesn't.
Yeah, we had a line of credit, I remember, for years that we never touched. And they'd like, "Hey, you want to renew it?" We're like, "Sure, why not?" It's like, well, by the time they gave you the 87 steps you had to do to renew a line of credit, which was about a tenth of what we had in our checking account, I think at the time, I'm like, I'm not doing this.
Right.
Like, why do we need
personal financial statements? You need checking. Tax
it was
returns.
like
you need this.
Firstborn, the middle name. Like, what are we doing? So like, well, that's interesting. So that is an option for some people if they have those type of relationships, right?
Right.
And so lastly, when I printed out a essentially like a matrix of the three main ones that we see, right? We do get some cash, but that's kind of obvious what the benefits are. You just pay and go, right? But 401k rollover, SBA loan, and HELOC. And so just working through those. So, the criteria, like no repayment required. That would be ROBS. You do have to repay SBA and a HELOC, obviously, because those are loans, right?
Yes.
The speed of funding. So, HELOC, you mentioned like 4 to 6 weeks. Here they have 3 to 4 weeks.
On the ROBS, you mean?
I'm sorry, on the ROBS. Yeah, sorry. The HELOC is 2 to 6 weeks.
Yeah,
Typically, it just depends.
Usually, a lot of people have a HELOC in place.
Exactly.
So it's just there. You write the check.
Exactly.
So it depends on if you have to initiate a HELOC or not.
So you initiate a HELOC 2 to 6 weeks, 401k rollover, the ROBS 3 to 4 weeks, and then an SBA loan is going to take forever. So 2 to 4 months, and I would say maybe a little longer these days. So just plan on that. Retaining 100% ownership, your 401k for sure, your rollover, your SBA, no, right? HELOC, yes. Just meaning like your SBA loan is they sort of own your business, right? In a sense.
Right. It's like a lien holder.
Yeah, basically on the business, whereas a HELOC is a lien holder on your house, right? And so it's like, it just depends on your risk tolerance and where you feel like you have the most leverage, right? No impact on your credit score. Obviously, ROBS, the other two do. No collateral required. ROBS wins there as well. You don't have to put up any collateral, the business and or personal. And again, if you have high retirement savings, best for that, certainly ROBS, right? If you have strong home equity, obviously it's a HELOC. Credit score, obviously you don't have to run any kind of credit score for a ROBS, but it also doesn't help you with your credit score. I don't think a lot of people are concerned with that, but it made it into this matrix somehow. SBA loan, HELOC obviously count towards your credit score in a positive way if you stay on track, right? You make payments on time. Complexity and difficulty setting up. The ROBS is moderate. The SBA loan is high, which we've talked about. And a HELOC is pretty low. Right? Pretty basic. Risk to your personal assets. Obviously, the ROBS, it's your retirement fund. If you flub it, you have lost that money that you're setting away for future retirement. An SBA loan, the collateral and the personal guarantee, right? So you not only lose the business, but you are also, and typically if you're not paying it, it's not going well. So that would make sense. And then you're also personally guaranteeing this loan, right? So, and then obviously on a HELOC, you're at risk of losing your home, right? If you can't pay it. So that's your personal risk or to your assets. And then obviously allows you to use retirement funds. That's only ROBS, right? Which I don't know. Like out of all these, I like ROBS the best, or cash, or maybe a combo of all of them. But it really is just up to you. You guys are we just wanted to give you an idea of like how you can fund a franchise. We've had all of these scenarios that we talked about with all the franchises we've awarded. You really just have to decide what's best for you. But I think it's a good idea at least to have this information, and then you can make a better judgment, right? Or a better decision on which way you want to go. Right. Any final thoughts?
No, I mean, the only other thing I can think of, like a lot of people are hesitant about the HELOC because there's so much writing on it, especially if you have a family. But even if you go to the bank and get a commercial loan, they are going to ask you for collateral. And that's going to either be your home or, your business, probably your home. They want something that they know they can go get.
Right. Well, let's be honest. Like if you're doing a ROBS, you might be like, sweet, I'm not personally guaranteeing anything. Well, if you're getting into a franchise, you're personally guaranteeing your franchise agreement.
That's right.
And if you're in a brick and mortar, you're personally guaranteeing your lease. So just keep in mind, a personal guarantee shouldn't be something that scares you off.
Right.
Because if you're getting into franchising and you're opening a brick and mortar business, you have to sign those anyway. You're going to be guaranteeing a lot of things personally. Listen, the other side of the coin of an opportunity is risk. That's part of the risk. Right. So you're betting on yourself and you're betting on your franchise partner to have a business model that works. Just keep in mind there's going to be exposure personally regardless of which way you go, and that's just part of doing business. Right. Do you agree?
Yes, absolutely.
Well, I hope that helps everyone. Thanks for coming on because you had a bunch to add that I didn't even think of, as always.
It's my job.
Yes, it is. It certainly is. Anyway, thanks. I appreciate you.
Thank you. I appreciate you too.
Cheers.
Peace out.